I often focus on the 20 exponential moving average because it's widely embraced by both institutional and retail investors. Among technical analysts, it holds popularity as a dependable indicator of market trends. However, solely relying on the 20 EMA might not yield significant profitability. To create a successful trading strategy, it's essential to incorporate proven elements from price action. One of the most powerful additions to complement the 20 EMA is a specific type of trading range, referred to as barb wire. This particular price action is characterized by an extremely tight range or consolidation, often comprising numerous dojis and small candles with narrow bodies. Barb wires come in different shapes. Some have upward or downward angles, but the ones we prefer to use with the 20 EMA are mostly flat or horizontal. Before exploring this strategy, it's crucial to caution against trading within any barb wire formations. They are highly unpredictable and widely regarded as significant capital drainers in the realm of price action. Barb wires often appear near the 20 EMA and seem tightly connected to that line, almost as if adhered to by an invisible force. The initial strategy I'll explain involves the price moving out of a narrow trading range, or barb wire, and retracing back to the 20 EMA. These pullbacks offer traders excellent breakout trading opportunities. However, it's crucial to be mindful of the market sentiment. To keep things simple, I focus solely on two primary factors: the price action preceding the barb wire formation and the general direction of the 20 EMA. Since these two factors may not always provide crystal clear clues, I won't present ideal examples that rarely occur in real markets. However, it's essential to develop a comprehensive understanding of market direction by studying these two factors, despite their imperfections. In this case, prior to barb wire formation, there was a notable upward surge. Presently, the market appears to be in a recovery phase, resembling a triangle pattern. The price can break out of this consolidation and resume the prior bullish trend at any moment. According to the slope of the 20 EMA, there is no noticeable upward or downward trend. However, given our current consolidation phase, which appears to be nearing completion along with the repeated tests of the upper trend line resembling the pre-breakout structure, we are focusing on the triangle's breakout. After the price breaks out of the triangle boundaries, we seek trading opportunities when the price retraces to the 20 EMA. You can place a limit order at the 20 EMA, or if you're more cautious, you can watch for rejections at that level. Finally, with the formation of this pin bar, we can enter a long position and set our stop loss below the pin bar's low. Given that this strategy is primarily designed for scalping or capturing small swings, it's crucial to exercise caution when determining our exit points and avoid setting unrealistic targets. This gains more significance when we observe these two consecutive pin bars. With this in mind, the triangle's inception could serve as a viable take-profit level. Barb wires are also notorious for false breakouts. In this example, the price broke out of a narrow trading range from below but swiftly reversed its direction, forming two solid bullish candles. However, considering the behavior of this pattern and the prior buying tendency, along with the bullish 20 EMA slope in that area, we may wait for a price recovery. Then we can seek potential long entries as the price bounces back and rejects the 20 EMA. Catching a pin bar on the 20 EMA signals a potential long entry, with the stop-loss order placed below that line. However, opting for the more secure strategy involves waiting for a second pullback to the EMA. Keep in mind, the market might not always present this second chance, resulting in a missed opportunity. For me, that's acceptable, as I always prioritize well-defined setups. When considering take profits, one option is to target previous market highs. Alternatively, by detecting a new rally, we may want to stay in the trade and look for potential reversal signals, such as the emergence of these two bearish pin bars. When trading with this strategy, it's essential to closely consider two main criteria that can notably improve the quality of the signals it generates: trending markets and high-quality breakouts. The primary consideration should be the market's volatility in which you trade. A more volatile and trending market increases the likelihood of successful trades, offering potential for higher achievable targets. Here, you can observe the price in a distinct uptrend before consolidating near the 20 EMA, forming a barbed wire pattern. Following this consolidation, it breaks out decisively with a strong green candle, followed by another sharp upward movement which could result in significant gains. But in this scenario, it's evident that we're in a prolonged consolidation phase, indicated by the nearly flat 20 EMA. Additionally, the breakout candle's quality is in doubt, as it mainly comprises a wick rather than a substantial body, questioning its reliability. While there might be potential for profits in this setup, the true distinction lies in the quality of the trading signals. This quality sets apart patient traders from those who impulsively enter and exit markets, unable to control their emotions. Here are a few examples showing how this strategy can also be effective in a bearish market. In the second strategy, the initial requirement is a swift price movement in one direction, typically characterized by consecutive large candles of the same color and devoid of substantial pauses. We commonly term these price action movements spikes, a topic extensively covered in another video available in the description. Following the price pullback to the 20 EMA, we look for any signs of price rejection around this line. After that, we await the second pullback to the 20 EMA, searching for trading opportunities as the second rejection becomes evident. Keep in mind that the second rejection from the moving average might not always hit the exact line spot on. Sometimes it might slightly overshoot or undershoot. But here's the deal. If there's significant deviation from the 20 EMA, it could signal a flawed trading setup that might not be worth the risk involved. When considering whether to take a long or sell position after the second pullback, I advise looking for reversal patterns in lower time frames for an ideal entry. This is because sometimes the second price rejection happens quickly, potentially causing a missed trading opportunity with a good reward-to-risk ratio. When it comes to finding the right spot to set the take profit, I usually turn to the Fibonacci extension tool on the toolbar. I measure the spike's length and aim to exit my trade somewhere between the 0.618 and 0.786 Fibonacci ratios. It's like finding that sweet spot where I think it's best to wrap up a trade. Here are some examples of this strategy in both bear and bull markets. I'd like to share 2 additional bonus points that can significantly enhance your win rate when trading with this strategy. These insights stem from extensive backtesting across various assets. When observing the first pullback to the 20 EMA, we typically prioritize shallower corrections over deeper ones. To determine this threshold, I use the Fibonacci retracement from my toolbar. I search for corrections that terminate before or around the 0.382 Fibonacci ratio. From my experience, corrections deeper than this level pose higher risk levels and might not yield high-quality trading signals. Occasionally, I've seen trading setups with deeper corrections turn out to be profitable. However, as I mentioned earlier, it's generally advisable to consistently look for more valid trading setups to improve win rates. The second point concerns the quality of rejection when the price approaches the 20 EMA for the second time. For instance, in this scenario, despite forming a pin bar on the moving average, there are no subsequent candles that confirm this rejection. Instead, the 20 EMA is breached by a strong bullish candle, completely nullifying any sell entries and potentially signaling a trend reversal. Here's the third strategy, and it stands out from the previous ones. While the earlier strategies focused on riding trends, this one takes a different approach. It's a counter-trend strategy. When you observe market movements closely, you'll notice that they often hover near the 20 EMA. This consistent proximity to the 20 EMA is a key characteristic indicating a healthy trend. But there are occasions when the price deviates too far from the moving average. This situation can present traders with an opportunity to enter a counter-trend trade if they notice significant reversal signals, particularly in lower time frames. For example, here the share price has been moving above the 20 EMA for a while. For the most part, it managed to keep a close distance from the line, which, as we said, is characteristic of a stable trend. When the price abruptly surges and creates a significant distance from the moving average, it often triggers a predictable correction. Following this correction, the market may resume its upward movement, though with reduced momentum. The decrease in momentum is usually quite evident, and you don't require any indicator to recognize it. Sometimes the price enters a wedge pattern, which is highly effective in signaling trend reversals. Many traders anticipate a rejection when the price touches the upper trend line of the wedge pattern for the third time, seeking opportunities to enter short positions in a bullish scenario. So based on the market context, we are already at levels that favor short trades over long ones. From here, we're looking for the right setups based on our strategy to go short. The first signs of a possible reversal show up when we see this long wick doji on the daily time frame. There are plenty of indicators out there to help us spot market reversals. One that really caught my eye, and I introduced it in one of my videos, is Auto Harmonic Patterns V2. It does all the work of plotting harmonic patterns on the charts automatically, saving you the hassle of doing the calculations yourself. Notice how this indicator identified a crab pattern precisely where we're seeking reversal signals and highlighted that area in blue. By now you've likely got a clear idea of gearing up for a short entry, but, as I mentioned earlier, for more precise entries, it's helpful to shift to lower time frames. Here, when we switch to the H2 chart, you can spot a triple top pattern forming. Following a brief consolidation, the price rejected that level with a substantial candle with a noticeable upper shadow. Subsequently, we can seek another rejection, or, as my preference, set a limit order at the breakout point. I prefer the second approach because in this strategy, we select the 20 EMA, drawn from the higher time frame, as our ultimate take profit, so waiting for the second rejection might not offer a reasonable risk-reward ratio in this context. Given all these factors in play, this looks like the right spot to go short. For the stop loss, placing it above the triple tops pattern seems prudent. And for the target, we could eye either the 20 EMA or the lower trend line of the wedge pattern. If you discovered useful insights and learned something new, please like the video. Thanks for watching.